Good afternoon, everybody. This is Jeff Scott. It is January, I guess I should have put 4th, not 5th, but it's January 4th, and it is approximately 1:45, so this is before futures are available. Title today, Weekend Review, New Year's Worries, or just low volume jitters. Here's my email address. Feel free to contact me, questions, comments, concerns. Disclaimer, this is for education purposes only. Anything it recommends in the spirit of education and should not be considered investment advice. I'm a doctor, not a broker. I am truly independent. I have paid for all the tools that I demonstrate. And most importantly, trading involves risk. You and you alone are solely responsible for any investment decisions you should make. As you make your investment decisions, I think that, as I said, I'm a doctor. There's obviously a lot of years of schooling and education that goes into be a physician. I believe there's an equal amount of necessary education and continuing education to be a successful investor / trader. These are just some of the folks that I learned from, and I like to call what I do and when I help people is to help them become their own guru. These are who influenced me, starting with William O'Neill, How to Make Money in Stocks, Ron Brown and Ian Woodward, who really took what O'Neill developed and brought it forward and enlarged it, enhanced it, and then working with George Roberts created HGSI, the software tool, which allows us to make it much more easier to use than a pencil and a newspaper. Morales and Catcher, two ex-traders for O'Neill, who brought us things like pocket pivots and Bible gap ups. And starting in April, we're supposed to have a short selling book from them as well. Elder and Lavorne, Alexander Elder's got a number of great books. I use his plugin from elder.com in TradeStation and in other products. Big fan. I've done live education with them. My buddy John Person, these are a couple of his books. Highly recommend them, as well as his online education programs and live meetings. He spoke at our June meeting and it was a big hit. Anna Cooling, one of the many folks that look at volume price analysis. She's perhaps the most approachable, and her book's quite inexpensive on Amazon. Van Tharp for position size and money management. My buddy George Lee, whom I'll be talking about in a few minutes. And then something that I've actually got quite interested in is point and figure charting. Not necessarily doing point and figure charts on a daily basis, but really looking at comparative relative strength among stocks, industries and sectors, and instruments, and especially as we go into a period of time where stocks may or may not lead, and I wonder about bonds, international plays, other opportunities. I think it's great to have a product that goes beyond the U.S. stock market and looks at comparative strength among different tradable instruments, and that's what I took from Dorsey's book as well as his website. I have a lot of programs. I often joke in live meetings to stump anybody so they can find a program I don't own. It's not easy to stump me because I have spent way too much money on products I don't use. This is what I need if I'm on my desert island. Toss and TradeStation are my trading platforms of choice. Genesis is another live platform. Frankly, I can do things in Genesis I can't do anywhere else, and that's why I continue to pay for it. And then I get my data, some of my data free, especially in the futures from brokers. From an analysis perspective, HGSI, which has been my end-of-day platform, and Ron's done a number of movies to support the new release. Ron Brown, it's now got intraday updates, Edge Rater, seasonal analysis, pick your poison, I like Magenta, and various websites. George Lee, I think, uses more websites. I use more HGSI. As always, I look at this picture and I wonder, where are we? And, you know, we're back here again, where it looks to me like this market's rolling over. But to be honest, over the last couple of months, quarters, 2 years, we get here, sometimes we get a 5 or 7% pullback, and the next thing you know, the market goes up again. So we've really been in a climbing a wall of worry and continuing to get small setbacks, and we go higher. At some point, it's going to be different, and I had to personally prepare myself for that and unlever, and I did a number of things at the end of the week that set me up in case we have a pullback. And if we don't, then I'll quickly cover those hedges and go all in again when it's appropriate. Right now, I'm not all in, and I put hedges in for a falling market. Market thoughts, not a lot last week. It was a quiet week. Low volume sell-off perhaps picked up a little bit on Friday. Is this the start of something new? Is this the deflation? Is this the fear of rising U.S. interest rates, which is hard to believe how you put that in the setting of a worldwide deflation? Is it Greece woes? Is it just some profit taking before the new year came in? I don't know what it was, but it was painful in certain sectors. Technology hit a wall. Biotech, some of the big guys had some issues. Even airlines the last 2 days sold off, but on low volume, so maybe not important. There was strength. If you paid a dividend, you look good. REITs, utilities, MLPs, and financial managers. Cover of Barron's this week is all about yield. And they have a great article about REITs, which are expensive. Their PEs are about 25 when the normal PE is about 16. On the MLPs, the concern about reducing revenue related to lower oil prices, how's that going to impact? You saw what Line did, or maybe you saw what Line did on Friday, LINE. I think it's LINE, not LNN. And it cut its dividend in half, but still has a 10% payout. Speculative biotech, think Kite, think BCLI. These are not your big players. These are story stocks, brainstem, that have interesting stories that seem to pop last week. And China, I mean, is it time to jump back into China? BITA, YY, and VIPS, three stocks that I've been in and out of for 2 years and made money on, kind of look like interesting places to come back into, maybe even NOAA, the Chinese asset manager. But the big question is, will the return to the market of volume, everybody come back from the Hamptons, lead to profit taking and a sell-off? Or is there cash that's coming in to move the market higher? Last week I teased you about Netflix. Netflix had a nice week last week, moving from the bottom of the channel to the top of the channel, but Netflix is still in a downtrend. The reason why I teased you about it is it's got one of the best seasonality pops that comes in the third week or so of January and really lasts for several months. I think it's 10 and 1, 10 years positive, 1 year negative. Hard for me to know when to jump in, especially in a stock that appears to be in a downtrend. If it based and started to take off, then I'd be buying some, perhaps 1 or 2 strikes out of the money calls, maybe selling some bear credit spreads to take advantage of the move. That said, it did miss earnings in the last quarter of 2014, and it can drop as well if it misses earnings. Just to remind everybody that George and I will be doing our summit February 7th through 9th here in lovely, sunny, 80 degrees, minimal humidity, South Florida. This is the time to be here, and fortunately it's starting to clear out just a teeny bit from all the folks that were down here for the holidays. Hard to get parking in the condo when everybody's here. Here's the information. Would love to have you. Thanks to the couple of you that took my call took my request and let me know last week and confirmed. Love to have probably 4 or 5 more people, and then I'm going to start thinking about shutting it down. It's $800. You can read what's included. I think it's a bargain for what you get. And in conjunction with that, George Lee and I will be doing a webinar courtesy of HGSI and George Roberts on January 7th, which is Wednesday, I believe, at 8 p.m. There is the address for the registration page. I'll include this in the email attached to the presentation for those that get the invite or the presentation notice via email. What we hope to do is work through some things we're going to talk about during the upcoming seminar, and this will include some of our thoughts about the first quarter, the current year, and about that Netflix trade. Week ahead, busier perhaps second week than normal because the employment numbers, which were not released on Friday because the holiday will be out this Friday. These have been a lot of upward surprises. They've brought some of the expectations down as we move out of the holiday season. Um, and so the bogey perhaps to hit's a little bit lower. We got some energy numbers, which have been important in market moving on the natural gas and the oil side, some factory orders, and the all-important FOMC minutes. From an earnings perspective, not a busy week. Now, that said, Micron's important to me not only because I have a position, which I'll probably take my profits and close before earnings. At least that's my gut right now, unless I buy a collar if it's not too expensive. And then Greenbrier, which is a stock that I've owned and want to own again. But Greenbrier is interesting because Greenbrier and Trinity both have pretty significant sell-offs, just like the rails and the support of the frackers like High Crush, Silica, US Silica rather, and EMES. And they all sold off because of the expectation of reduced revenue, shipping volume, etc., out of the Great Northwest from some of the shale entities. Now, Greenbrier and Trinity have a huge job ahead of themselves where they've been remanufacturing, restoring a lot of train rail cars to meet the current government mandated, what's the word I'm thinking of, expectations, requirements from a safety perspective. Be interesting to hear in their numbers and in their discussion as to what the impact on the slowdown in shale, how that's impacted them. Are they seeing a slowdown in shale oil, and what their expectations are going forward? So at this point, let me turn this down and go and look at some data. Let's take a look at my Excel spreadsheets. So one of the first things that I do in EdgeRater is I try and understand what is the market doing compared to expectations. So this was 2013. Obviously, it was last year. This was typical of a very good year. For example, you see, just get a shape here, a gradual increase over the year with higher returns based upon ERG. I always throw out the tail and the head because there are very few stocks when you get to the extremes. But if you go where this is the number of stocks at the different ERG levels, earnings are EPS plus relative strength plus group rank. And the expectation in HGSI philosophy is higher ERG stocks do better. So if you looked in 2013 and looked at fundamentals based upon the beginning of the year, this is what we saw. We saw higher ERG stocks with higher return. Good year for everybody, 25%, 30%, up to 60. Hard to complain there. EPS rank, higher the EPS rank, the better, although not unusual to see stocks that are newbies that don't make money sometimes outperforming in the more speculative, perhaps, sense. Relative strength. So both these charts are based upon the value in January of this year, or December 31st, and it shows that relative strength, like earnings per share rank, at the beginning of the year led to higher returns versus lower relative strength. So EPS and relative strength are important, and this is similar if you look at CanSlim, leading companies with good earnings. Those are EPS and relative strength things, and those are meaningful. In 2013, group rank did not mean anything, and I'm not surprised there because about the only time I see value in group rank is over short periods of time as the market comes up and down various groups. And the other thing that's not unexpected is the A's and B's in accumulation outperformed by return the C, D's, and E's. Now, the interesting thing here is what was best was B. So they perhaps have more room to go up while the A's can only go down. But these were the A's and B's on January 1st. And when looked at for the entire year in 2013, the A's and B's outperformed. By boxes, no box was about 25%, and you could see box 7s, which is my favorites, outperform 1s, 2s, and 3s, and 6s all did well. 6 was the leading group. So that is a typical year. What we saw last year, not so typical. Now, I guess what should make me happy, because I'm a big believer in this stuff, is that I guess I could squint and see that there probably was a higher return for those stocks that had higher ERG. But boy, it's choppy here. But here's where it gets interesting. On January 1st, 2014, there's really no great pattern here. The highest EPS ranked stocks did lost for the year. The lowest EPS lost a lot. Highest relative strength perhaps was better, but the highest relative strength did not outperform. From a performance based upon group, remember that the average return of the market was closer to 10%. The big gain was in the Ds. So the crappy stocks on the beginning of the year from a distribution perspective actually outperformed, and the boxes are all over the place. So the 6s and 7s had a good year compared, but the box zeros actually did fine. So this was a year perhaps where relative strength and earnings and accumulation distribution were less important. Now, how do you put that into context? Was this a year of junk off the bottom as we get late in a bull market and defensive posturing? Perhaps. Was this a move to high interest plays, so REITs, MLPs, utilities, things that were not high growth, relative strength, or EPS ranked the prior year? Whatever the reason is this the beginning of a trend where EPS and relative strength become meaningless, or was it just an aberration? My guess, it was just an aberration. Now, I'll show you how I did this, because let's look at the last quarter. I'm going to go into Edge Rater. I'm going to go into Change Settings, and I'm going to go find something that ended around the end of September. So, you should never do things on the fly without being prepared. So God only knows what I'm going to show you, but this is how I do my analysis. So I keep track of a lot of things. I'm going to go into what's called my HGS buys. And do I have some that's the end of October, early November? I don't have one here. All right, so let me find one on my other computer where I have more files. And let's see if I can find something. Bear with me a second here. Guess while I'm doing this, let me go put the link for the live meeting up in case somebody wants to write that down. So I'm looking for something that's around 10:30. 10:30. Let's see. I keep a lot of these stored on another computer. Oh, come on now, where do I have these? Dropbox. So we got 10:27. That's pretty good. All right, I'm setting this over. All right, so what I'm going to do here is I found one. That's too soon. One more time. Early October. All right, got one. So go in here, find it. so bring it over to this computer. So I'm going to go back. Here's how I generate those reports. And I've had a number of questions. Sorry about that interruption. Shut that down here. So I'm going to go into my Dropbox for today, and I'm going to find, these are all the securities first week of October, and I want to look at performance from October 1st to the end of the year. And I want to use warehouse all securities. Hit OK. Now I'm going to hit run. And that's going to go through, find the stocks that I have data on, because one of the problems here is some of the stocks, especially when you look back multiple years, may no longer exist anymore. And let's take a look at the dashboard. So this is strange. Did I not capture relative strength? Well, you could see over the last quarter, that makes no difference. All right, that's the problem. Let me just make that 0. For whatever reason, I've got an error in my data, and that's caused a problem here. So let's see if I can edit. I don't think I can edit that. All right, so the reason why the relative strength is a mess is because there's something abnormal here. But if you look at it, the higher relative strength certainly outperforms. So the last quarter, the 90th top percentile is up 8%, the second from the top up 7, 5.5, 4.5. So the good news is that in the second quarter, relative strength mattered. In the fourth quarter, relative strength mattered. EPS rank mattered. Here's where group rank matters in a short period of time. The boxes and everything, let's go into the actual hard data. Box 7 was actually down for the quarter, which is interesting. Box 1 and 2, 4, 5, and 6% were leaders. And if I look at ERG, you could see that the higher the ERG, the higher returns. So the point of this exercise was to show you that you find your file, set your dates, and run, and you could duplicate this information. So maybe, since the last quarter looks more like 2013, maybe normalcy is back. Talk about last week, black versus red. Red are down groups, black is up groups. And remember what I do is I take a lot of different watch lists I prepare over the weekend, and then I get an idea of what's working, what's not working. Now, the stocks that I had going into the week basically did nothing. We're up 0.06. The ones that I looked at buying as potential were actually down 1.7. The GAF All-Stars were down 2.13. So what's the message there? The message is some of the things that we do, high growth stocks were not working. Cancel stocks were probably not working as well. They were down 1.43. S&P 500 was down 1.46, and the HGS 100 1.32, and the IBD 50 1.26. And you can see most groups were down compared to last week. So what was leading? This is a short group, and they were actually up. There was only one stock. Bible gap ups, breakouts, very bullish screen, but not many stocks. Mobile breakdowns were leading. So another week of upside down where some of the things that would expect to do poorly were actually leaders. No Hindis last week, no surprise. The new lows are down below 1%. Bucketology shows that half the stocks, or 67% of the stocks, S&P 1500 are above the midline, and there's certainly no exaggerated amounts at the high or low end, so we're kind of neutral. The markets, Santa Claus rally, we had some big kahunas which took us out of the red and got us into the yellow and green, mostly green. So we're on a HGSI, I guess you could say, been okay to buy. The yellow popping up is a little bit bothersome. I could look at all kinds of different setups. So I want to just look at seasonality for a second. And specifically, I want to look at, I'll look at this. If you look at 1 month, the spiders are up only 12 out of 20 years. S&P 500 is up 12 out of 20. The big ones that are up a lot of years, 11 out of 16, is healthcare. And the other one that looked impressive was not by percentage up, they were up 6 out of 8 years, but home builders. If I look at return over the next month, biotech, home builders, gold, healthcare are positive. Interestingly, despite the fact that we expect January to be historically a decent month, most of the groups in January are down. The Dow 30 down 1%, but it's only down half the time. The leaders, biotech, home builders, gold, healthcare, REITs, but really no super performance where we saw 11 and 1s and 12 and 2s like we saw a couple weeks ago. All right, now I like to quickly look at my elder indicators to see whether they're giving me a okay to be long or not in this market. I think you can guess what they're going to show me, which is going to be probably a lot of red. So remember, I use TradeStation for a number of things. These are the elder indicators, and I had somebody ask me about where you get them from. Where I go is, I thought I had it. I have multiple monitors, so I have to bring things over. I've gone to www. And under here, it says book software video. Under here, it says software. And this is the MACD divergence scanner that I use. Here's the TradeStation 9 indicator set that I use. And you can see he's got them for other programs as well. So we're going to look at the impulse indicator, which is the color of the bars, and we're going to look for evidence of person buy and sell signals, which is the magenta here in the blue, and then the evidence of MACD divergence, which is the little red dots on the price bars. So let's start with the NASDAQ. NASDAQ sort of has had a double top and rolled over. You have a person sell signal in the setting of MACD divergence on the daily, red, not so bad on the weekly MACD divergence, but it's blue, and it's blue on the monthly. So a bit of a discordance, so I'm less nervous than I would be if the weekly was red as well. But with this being red, I don't see a reason to run out, jump into the market, and buy NASDAQ futures on Monday morning. Now, what's interesting is the way that he set this up is I can tell you that on tomorrow, which will be January 5th, I've got to get the NASDAQ, which is at 47.26. When it gets at 47.63, it will turn blue. And then we know from doing this before that when the indicator is blue, it's not giving you a strong signal. You can be long, short, or hold. When it's red, you should not be going long. And when it's green, you should not be going short. So the NASDAQ is red to blue, so I would say negative, but the blue weekly perhaps mitigates it some. The Dow, MACD divergence, it's red, blue, MACD divergence, the story is the same. What does MACD divergence look like? Well, the MACD divergence is higher highs, and we're making lower highs on the MACD. Not as perfect an example here as I might have. So the Dow, red and blue with MACD divergence. Russell, red with MACD divergence and blue. E-minis, red, MACD divergence relieved here as the stock has come down. NASDAQ futures, red and blue. S&P 500, red and blue. MACD divergence, S&P 100, red and blue. So red and red is more negative in my mind. Green and green is happy times. This is a mixed bag with the red and the blue on the weekly. So it advises me to have some caution. Now people ask, what do I do with TradeStation during the day? And I've built in my indicator set here, as well as some indicators that I purchased, and then the free earnings indicator, so I know when earnings are coming. And I basically will put together a massive watch list, and I can look for viable gap ups in real time. So 10 minutes after the market opens, I'm going to know what your gap percent was. And then 10 minutes after the market opens, 1 minute after the market opens, I'm going to know what your volume is based upon the requirement to meet a viable gap up according to Morales and Catcher. And then I'm going to be able then to look at these charts real time to help make my decisions. And you'll notice some of the big winners here, and these were showing up very early in the morning. I can also look for mobile breakouts from a squeeze real time. Drives me to take a look at these stocks. I could look at green candle lows, which might be a reversal signal. I could look for pocket pivots up and pocket pivots down. This is only the volume signature. In reality, to do pocket pivots, you really have to have a good look at the chart and make sure it picks off the moving average or gets close. So I monitor a big bunch, and then I stick it into Thinkorswim or TradeStation to trade. Whoops. That's not happy because I changed my resolution. All right. What else do I want to do? All right, let's now go into HGSI and take a look at the market. So I'm going to open up my warehouse view. Apologize while I resize everything as I bring them over. If I do this in my 4K resolution, you'll all complain that the upload is way too big and you won't be able to read anything because they'll be too small on your computer. So that's why I changed the resolution for these. So I'm going to start by just going into Major Markets Plus, which are courtesy of Ron and Ian. And I'm going to go to top down, which is all technicals, price, and volumes, heaviest on 1 day, a little bit on 5 days, and just a little bit paying attention to the 3 weeks. And I could see that the leaders for last week were Treasury bonds. When when bonds are the highest, then you know your stocks aren't working. The dollar was up there, utilities were up there, part of that dividend play. On the bottom, oil and gasoline and commodities continue to do poorly, and then you see our stocks. Let's take a look at some of our favorites. Let's look at the S&P 500. And again, the first time I'm going to have to size it. So on my big view, which I'm going to take off in a second, you could see that the bongos started to turn red on the daily. There was a mobile breakdown, but there's no kahunas or eurekas or pocket pivots, which you wouldn't see because there's no volume. So I like to look at my indexes with just a pure moving average chart. So what do I see? I see that if I look at a weekly chart and I make more data on the chart, and I want to try and play a little bit with some numbers, that if I draw a trend line from the low here and take it up to our close on Friday, we are up 211% in 300 trading days. Okay. If I want to tighten it up a little bit, take that off, and just look at in 2014. Let's see. Here's the last close, let's say of 2027 on a weekly chart, 2013. And let's go to the current close. We were up 11.6% in 1 year. So this has been a big bull market. Is it slowing down? Yeah, it's slowing down. It wasn't as much of a big move as I saw in 2013 in my stocks. But from the big stocks, it's still a nice run up here. It's hit the 50 weekly once. That was back in October, which was when we had our deeper pullback. Let's go back to the daily. The issue now is, looks like we've rolled over here and put the top. So the question is, are we at a point now where the market opens and goes back up on Monday? Or we at a point where the market wants to, so are we going to go out, take out highs, go to all-time highs? That's possible. Or are we likely to start to work our way down into a correction and move up and move down further? And I'm going to bank that the latter is more common, more likely, and that we're going to see some profit taking. But I have no idea. So right now, I took some positions to protect me. I still have a number of longs. I guess net, I'm long, but I'm not all in by any means. And I'll wait and see what the market does. That's a doji on Friday. And I know that that tells me that the direction that the market opens is likely to be the way the market trades. So I'm going to watch for that. I realize that this is a market of stocks. And boy, this is a pattern that you'll see on a lot of stocks where they look topping. And the question is this over? Is it ready to reside? Is it going to go down to that 50 and bounce as it did many times in the past? Or is it going to go down and kiss the 200? Or even go down here, which would be about where the 200 is when it gets there, and meet up with the most recent low. Time will tell. I have to think of upsides and downsides and where this might be going. I look at the Dow, took out prior high, sold off, doji long-legged, just like the S&P 500. I look at the NASDAQ. Double top, few days of selling off. Now, these are low volume sell-offs, occurred in the holiday, without a lot of market participants, and we are much closer to the top than we are to a bottom, and this market could turn around and go up, but I think you have to be a little bit at least concerned that this market is going to have somewhat of a correction. This was a triple top on the Russell 2000, took it off, sort of a bull trap, and it too sold off. So, it's hard to be bearish when all the markets are sitting just underneath all-time highs. But it's not wrong, I think, to at least consider the fact that this market might need a little bit of a pause to refresh. If I look at what is working, we can look at the bonds, not quite to new highs, but certainly in a big uptrend. The dollar coming up to, I think those are July of 2010 highs here. Yep. Okay, so the dollar's had a huge run up, although it doesn't necessarily look like it's stopping anytime soon. I'd had a number of levels that I thought were potential reversal areas. Actually, this is September 2010. Here's earlier in 2010. And then we're going to have this one back here. So these are all potential vehicles. This is a very powerful rally. It's taken out multi-year highs. Parts of me believes that this keeps going, mostly because of the weakness in other parts of the market, of the world. But at the same token, I've started to see people calling for a top and saying that it's overdone. Strong dollar, you know what that does to silver and gold. This is silver in a downtrend. Now, is it at a place where it might find some support? Maybe. If I look at gold, had a nice day at the end last week, especially the concern about Greece blowing up, as you could see here. And this was what I thought would be support, and you could see I was wrong, and now sometimes long-term support at 115 turns into resistance. So before I'm jumping into gold, I like to see it get above that line. At some point, it's going to be time for gold. We'll see if that time is now. Oil, well, you know what oil looks like. And is oil, take a look at a weekly chart. Has oil reached the bottom? Don't know. It's interesting how from July of 2009 until September of 2014, how consistent oil has been. And now, of course, we're in the midst of a big sell-off. Doesn't look like it's done yet, but it might be. Some of the oil producers and oil service stocks look like they're bottoming, which might be early signal that oil is done falling. And then I just throw this out at you. This is commodity deflation. From the peaks of the summer down to where we are, the commodities are down 38%. I think I said this last week. What would you do if your stock portfolio fell 38%? Are the commodities leading the market? And with deflation, they're going to drop. Interest rates will fall further as they are in Europe, and I guess in Germany you pay them to save your money, in which case bond yields will drop and the price of bonds will go higher. Or will this be reversing at some time? Who knows? Oil, though, has joined the commodity sell-off. Next, I look at sectors to get an idea, or industries rather, of what's working. We'll take a look at sectors and look at two-day force to get an idea of what's really moving. And two-day force down, nothing moved down that fast. Five-day force down, you have technology, consumer discretionary, financials leading to the downside. If you look to the upside, 5-day or 2-day, you see the same thing, which is energy and healthcare. I think the reason why I did okay last week compared to the major indices was I'm overweighted in energy and healthcare. This is the oil play that I mentioned earlier. And what they did, which seemed to get Wall Street happy, is they cut their dividend to about 10%. Is this the one? No, it's not this one. This is Line, so it must be Lin. Yeah, this is the one. So one of the things to be wary of is that in any place you look, the dividend yield is going to be based upon current price and projected historical payoff. If the revenues are going to drop and they can't pay their dividend, then the dividend yield is going to come down. So Linco had a big gap up or big move up this week on Friday. I thought it did. Wait a second. Yeah, here it is. Because of a bullish engulfing pattern taking out its 8-day on volume. And let's go look at it the way I like to look at stocks with my webinar view. And you could see it had a mobile breakout near a PSAR reversal, volume coming in, because they announced that they're cutting their yield in half down to about a little bit over 10%. So you'll see a lot of energy plays whose pattern looks like that. Perhaps they're telling us that this market is getting close to a bottom in oil. Let's look at the industry groups. You can see 2-day up, there's only 22 versus 2-day down, of which case there's 10. So the ones that are really struggling, auto parts, medical devices, airlines had a tough couple of days. Now I'm long a bunch of these and I got to decide what to do with them. I've got stops in and you can see they were down. No one was down a lot. Here's United. This made it to my buy list, frankly. If this can take out its high here, you know, it got to its high jump with the red candle high, so that's probably no shocker that it pulled back some. But look at the earnings per share growth coming into a stock with a PE of 14.61. Who knows, maybe these guys will actually start paying dividends as well. So there's United. Hawaiian is one of my big success stories. You know, gave up its gains from Wednesday, from earlier in the week on Wednesday and Friday, kind of closed where it opened on Wednesday. Great earnings per share growth, similar multiple. This one was one of my favorite buys of the year, and I took it here We talked about Kahuna, mobile breakout from a squeeze, mostly green here. And if I remember correctly, there was a big volume that day as well. It went from 862 up to 1.17. That's not a big one. But I look for stocks that are taken out. They're 50, and you had the Eureka in the market here as well, saying it was all clear and time to jump back in. So Y and Holdings had a sell-off. So remember, the force here is looking at daily price change times volume. So these are all stocks with big volumes that move down 5% on GOL. Delta is one of my big holdings that didn't even make the list. Department stores, healthcare suppliers, semiconductors, which have been big leaders, made the bad list. That might be something. That's part of why I said I'll probably cover my Micron. Home builders had a tough day on Friday. What was working? Now, to be honest, long term, I'm still interested in airlines and home builders, but they're going to have to show me reason to be going back in them. EMP. So these are beaten up stocks. We showed you these already. Let's take a look at a couple of them. Lin Energy pays a 25% dividend, but remember they cut this in half. Looks pretty good. Might be one to go nibble on. Here's Lin Company. Looks exactly the same. Range Resources, EQT, Oasis, Apache, Brightburn. So I think these look like they put in the bottom. Now, this might be telling us that oil's near the end. It might be telling us oil's overdone. But they've all are putting in higher highs and perhaps higher lows. So are we out of the woods on these stocks yet? Probably not. But a lot of them look like they put in bottoms. And so higher high and a higher low if it moves up from here. So this is Apache. So I started nibbling in this place last week, and it looks like if you want to nibble, Lin Energy might be a place for you to start nibbling on Monday. Let's go back. Biotech. Boy, this is stuff. These things have been all over the place. So buy these at your own risk. Achillion is one of the Hep C players. They had a big day on Friday, still well below its PSAR and mostly red here. Big move, but it's got some work to do. Vertex, sideways, mobile breakup from a squeeze of Kahuna. Everything is green. That looks nicer. Don't like its earnings per share growth. Newlink, do like this one a lot. They've got some RNA-based treatments, perhaps an Ebola treatment, perhaps some cancer treatments. Got to believe this one is an acquisition candidate by someone. Looks like it's breaking out here to 8-month highs on a strong day. Celgene, you can see here it's due to make 486, 32% growth. That's $130, $140 stock in a pullback. Getting, I like buying this off. It's 50, and it might give you an opportunity if you hold your breath a couple more days. Arrowwood, this was the example of why you need to be careful in biotech. What was the darling of 2013 became the dog of 2014, all the way down to $6. Some rumors making it that Gilead is looking at them for an acquisition. Mankind, everybody on most boards I participate in, I think Ghilardi and I were two of the only bears on this, said, oh, this is great. They make inhalable insulin. Everybody's going to have it. And the stock is no higher than before the drug was approved. Gilead, one of my longs that I got whacked here. Fortunately, I had some protected puts. I don't know. I think resistance is going to be in this area right above where it's at. It might have to go sideways for a while. Word to the wise, starting a week from Monday, the JP Morgan HQ annual healthcare conference is in San Francisco. I'll be there, and tons of companies present to a lot of hedge funds in Wall Street. and that might make some movement in some of these stocks. Biotech, not a whole lot there. I don't see a reason to go long or short right now. Medivation, love the company, love its earnings per share growth. It's red above here. That makes me a little tepid. Anything here that really stands up to me. Chimerix has been in a nice up move. Kind of looks a lot like, what was the first one I mentioned? Looks a lot like Newlink. And then one that was real hot this week. Now this is the stocks that, that's not the one I want, BCLI. BCLI, this is brain stem cell therapy. They've got some treatments for Alzheimer's. They've got some data coming out. You know, we're talking speculation. We're talking gambling. We're talking Las Vegas here. But if their data in the current setting, and they went from 4.8 to 7.5, you can see how long the tails are on this. If their data is positive, it's a $20 or $30 stock. I remind everybody to a year ago, one of my better posts, I might add. We were sitting in the beginning of January in Intercept with its 20 employees at the time, or 25 employees, had this happen. And it gapped up from 80 to 230, got as high as 300 and closed at 273. Kind of looks exactly like the chart at BCLI with a lot smaller numbers. Next day went even higher, up to almost $500. I came on the board and said, be careful that this looks a lot like Entremed and other biotech stocks that run up like this. And then next thing you know, they get a new base. And they gradually, people forget about them. The hype goes away. And, you know, had you bought it at $80 and held for the year, you had a double. But if you bought it at $500, you lost 60% of your investment. Be careful with these high-flying biotech stocks. Obviously, here you don't have much to lose. All right. That was not any comment about whether they're good or bad. Just be careful. Specialty Pharmaceuticals. These guys came out and said they had a treatment for diabetic kidney disorder, common cause of dialysis and transplant. And they had a big pop-up on Thursday, kind of a shooting star. Sold off some on Friday, but still up. If you look at the weekly, a huge week. I just got to be careful with these stocks. From a drug development perspective, you'll hear about different things. You'll hear about phase 1. Phase 1 means we have no idea if the drug works, what disease it works in, and what dose we should give. So we give it to people who are closely akin to guinea pigs, and they're usually people with bad diseases that are looking for any chance. God bless them for taking that chance. And we use those patients to establish dosing guidelines and safety, and occasionally get a hint at some efficacy or value. In phase 2, we take patients with various diseases and we expose them to drugs that we now know what the side effect profile is, and we know what dose to give. We have no idea in a phase 2 study of whether or not the drug works. When you get a positive phase 2 study, it usually means there's a hint that the drug works, or obvious that the drug works, and you get safety to tell you the drug is safe to give. Then we do a phase 3 study which compares your drug to the standard of care. And it turns out that many drugs that look good in phase 2 are no better than the standard of care, and then they fail in phase 3. So be careful buying drugs because they are phase 2 winners. Nephrogenics, I believe, is a phase 2 winner. Here's Kite. What a beautiful run up. Doesn't make any money. Another one of these marketing biotechs. $2.5 billion market cap. Valiant, this is the guy, the serial acquirer. They actually, ever since they got out of the Allergan acquisition game, had a nice turnaround, sort of a nice cup here and a handle. On the weekly, perhaps they're getting ready for a breakout. This is one of my larger holdings. Why is it one of my larger holdings? That's why. And it was pretty painful here, but I had some puts. But it's had a huge run up in the last decade. Next group down, group number 4, midstream oil and gas. I mentioned searching for yield, and this is one that was mentioned by Barron's this week, Kinder Morgan. Let's put out a weekly chart. You can see pullback, nice uptrend now. Everything's green on the weekly. You can see on-balance volume is heading up on the weekly. And people like this because it pays a 4% dividend. Mark West, not as pretty a chart. ETE had been a big leader, pulled back below the 50 in EPD, Plains. So for the most part, this is a group that's been beaten up with the energy. They've obviously come up much off their bottom. And one of the nice things about the MLPs is they have a nice dividend yield. Precious metal mining. You saw gold and silver were weak, but some of the miners not so weak. And we did see a pretty big day on Friday in gold, just at a low point. AEM looks interesting. You had a long pullback. So is this sort of a cup here? This is the right side of the cup, breaking above the 50. Perhaps it runs up to the 200. Kahuna's mobile breakouts from the squeeze, everything turning green, and they pay a 1.2% dividend. This was my favorite chart in this group. Here's Goldcorp. Newmont, not too bad. I'd like to see it break above the 50. Look a lot like AEM then. Barrick's pretty broken stock, but they all seem to be changed their rate of descent and looks a lot like the oil stocks. Perhaps they want to start going up even without seeing the price of gold and silver. E-commerce discretionary. God, I don't know what to do with Netflix. Up $6 one day, down 7 the next, up 6 days the next. You get a lot of movement in this stock. Kind of looks like it's put in a bottom here. Here's its 50 and it's 200, so it's got some overhead resistance. Let's look at this on a weekly. Kind of where it was in April of this year. There's no question it's got some strong seasonality coming. The challenge I have here is that, let me pull this up here. Here's the challenge. Looking at the weekly, if I was to buy this bar here, the low is 315. It closed at 348. So I really, that's a 10% stop. That's a big stop. But if you have a tight stop in Netflix, I don't know. Here's 315 at the low. It's more than 10% stop. I think this is a tough one because the distance for the stop is too high. However, that said, with the seasonality, maybe you want to be buying some out of the money calls here, low delta calls, and take advantage of a big move without a lot of risk. Something to think about on your own. VIPs, this is a pattern I do like because I can put my stop right underneath that 200 and feel pretty confident. Now, if I was a working man, which I no longer am, I would say it closed on Friday at $20.50. The 200 is at 19.05. So I would put my stop at, say, 18.95. 18.95 to 20.50. $1.55 is a little bit less than 8%. The PSAR was at 20.91. So I'd probably put a buy stop in at 20.95. I would set my initial stop at right below that 200-day moving average. And then once I flip my PSAR stop, I'm going to try to raise my stop up into this tall bar very quickly. But I could put an order on this. Like, for example, I could go to Thinkorswim. And let's see if I can make this actually look all right. And I could go into trade. I could call up the IPS. I can go down here. And I'll close all these things down. And let's say that I want to buy 100 VIPs. I can come back here and I can pull back up my little data thing. I'm just going to move it over here so I don't forget it. So I want to buy 100 of VIPs, and my limit price would be that PSAR 2091. So I'm going to put a limit price of 20.95. Okay. And then I'm going to come down here, and my trigger marked the price trades above, at or above, that 20. So now what I've said here confirm and send. It says I'm going to buy 1,000 VIPs at 20.95. VIPs has to trade at or above 20.95. Cost to trade. And I'm going to hit send. Then what I would then do is I do a conditional order, which I'm not going to do right now, things that we'll talk about at our meeting, that basically says if I take that trade, then I'm going to set my stop, and as I already said, I'm going to set my stop right below that 200-day moving average, so a little bit over below 1905, probably 1895. And the reason I like to do that is if we trade below here, we violated why I did this trade. Frankly, if we go halfway down this bar, we violate why I did this trade. So I'll quickly move my stop up. So that's kind of how I traded when I wasn't at home. I'm at home tomorrow, so I'll probably watch this and say, gosh, a kahuna, pocket pivot, mobile breakout from the squeeze, turning green at support. It's been one of the things I'm watching in the pre-markets. Beta looks the same. YY looks the same. And this was the other Chinese stock that had been a leader that had pulled back. So something's going on with the Chinese stocks, so that might be something to watch. REITs, I mentioned they were strong. The one that I have right now, I got a couple of them. I went with some healthcare REITs for a couple of reasons. Pull back, starting to head back up, but more importantly, it pays a dividend of 4.9%. And the other one I liked was, is this HCN? Yep, HCN. Got some of this one as well, pays a dividend of 4.1. One that I liked on my weekend review Well, I've been liking the hotels. They've been leaders, and the hotel market's been doing well. No dividend on this one. Marriott is another one that's looked good. Entertainment Property Trust, uptrend, gradual, 5.8% dividend, and they do, as you could see, megaplex theaters, entertainment retail centers, recreational destinations, things that might do well in a strong dollar. So REITs, you need to know, I guess, a little bit about them before you buy them, and make sure that they're going to be able to support their dividend. Internet-based services, there's your beta. SoFun is another one of these Chinese stocks. Look at the relative strength rank of 6, so it's been a crappy stock in a downtrend, had a big move on Friday. I don't care. I'm not interested in that. I already looked at beta, which was the next one. Renewable energy. Now it's interesting with the price of oil being so low to see solar here. Here's CSIQ. I've been talking about this for a while. Great earnings coming into the stock. Clearly sold off hard, but the last 6-7 days has been up. Here's Trina Solar, similar pattern. Here's JKS. I guess one thing to do, can you just go buy TAN? Same exact chart pattern, doesn't pay a dividend, and then you have some of the news risk is gone, and you're kind of at a basing low here. So solar looks strong, hard to believe, but it does. And then utilities and power generations. Again, I mentioned utilities from a yield perspective. I just hit one here. NRG pays 2% yield. So that's where the strength is. Now, other things that I do on a daily basis. All securities. And I'm a big fan of volume, so I'll look at volume buzz. Take a look at these. The second one is a takeover. So this is a stock that must be a takeover as well. It had big volume come in, 3 million shares versus a prior day, 3.8 million, 178,000. So volume's up 15 times. I probably want to figure out why. So I'm going to take more info from the web, look at Yahoo. Sale of company, so that's a takeout. All right, so then I might go into 3x volume. Again, during the holiday week, not a lot of volume. And there's that, here's one that might be interesting to take a look at, Neurostem, a cheapy biotech, shooting star, so no interest there, but big volume came into this one this week. On Friday, its volume was 2.4 million. Typical is 1.9, 500, so it was at least 3 times normal volume. Other things that I look at Ghilardi Sprinters. Another place where I find a lot of great stocks. So I'm going to close like I did last week by looking at my buy watch list and comment on about 30 stocks that I thought were interesting. So let me just define something for you. If they're on my buy watch list, it just means I'm going to watch them. It doesn't mean I'm buying them. I don't, except for maybe VIPs that I just showed you, I don't have anything else loaded up yet. Some are buys where they're at. Some are going to require some work. So let me go through very quickly and comment on what I thought were some interesting looking charts and why. Newlink, we already looked at this. Biotech company, nice uptrend, takeout candidate, strength on its own. VIPs we looked at, pull back to support with momentum coming in and great earnings, which I didn't tell you. If you look at daily graphs, you'll see what I mean. Pharmaceuticals, this was the first year that it actually made money. Great earnings per share growing out. I own some of this already, pulled back, broke out above the trend line on Wednesday, finished the day up, the week up with a pocket pivot on Friday, like them still. Idera, don't know much about this, is a small biotech that seems to be breaking out here. Advaxis, another small biotech. pulling back, not jumping into this one yet, but I want to put it on a watch list. Look at how this on-balance volume took off. Noah Holdings, this is that Chinese asset manager, pulled back to support. Pocket pivots, had been a leader. Here's a trucker, lower left, upper right, extremely tight, giving us a buy point, I think, pretty much here, or I like to see a little momentum come in at this point. Everything is green, makes money. Kite was that speculative pharma and an uptrend. Blackstone Group, this is an asset management company, kind of looks sideways here. I got a pretty substantial position in them, and you could see after really getting down to the small single digits after 2009, that's when you had to buy these things. Nice uptrend since on the monthly chart, but what I really like about it is 5.2% dividend. They acquired a lot of different properties and companies that they've been spinning off of late. Chimerix, another biotech, nice uptrend. Clovis, I'll put this on my potential for acquired. From what I know about this company, another oncology product company with no revenue. Mobile breakup from a squeeze on Friday, right below the PSAR. I've got a piece of this, and I might add to it as a speculative play. New Star Group, this is one of those energy MLPs. Pull back, looks like it's done dropping. Dividend yield at 6.3%. Still got work to do. Here's one of the healthcare REITs that I didn't show you. This one has a 4.3% dividend. Spirit Realty, another REIT, nice uptrend, pays a dividend yield of 5.6%. Quick comment. I asked George a few weeks ago to put this little piece in here. I've now asked him to add dividend yield. If you find this useful, please send a note to George at highgrowthstock.com or hgs@highgrowthstock.com saying, George, thanks for putting this in, because I've asked him for some more. I think getting other feedback besides me would be helpful. Freescale Semiconductor, like many of the semis, looks like it wants to top and roll over. Liked its earnings per share growth. Again, this is a watch list. MAC has been a holding I've had for quite some time. I've had a great year since July of being around 6 up to 11.5. I continue to hold a potential takeout candidate in biotech. Fold, Amicus, doesn't make any money. Don't know much about it except I love sort of the cup, the handle, and the breakout. I think this is one that's viable as where it's at. Boise Cascade, I think this company went private and got relaunched a couple years back. Great earnings per share growth, breaking out to new highs. AEM, we already talked about this, a multi-material miner, golds, nickel, others. AEM, I thought, looked attractive from the miner perspective, pays a 1.2% dividend, breaking above the 50. Hudson Pacific Properties, another REIT that I like. They've had some recent acquisitions that looked impressive. Omega Healthcare Investors is another REIT. This one pays 5.1%. I like the healthcare REITs. Here's another speculative pharma play that I like the chart pattern, pull back and broke out on Friday with a mobile breakout from a squeeze, everything turning green, pocket pivot and a kahuna. That's Erie Pharmaceuticals, A-E-R-I. Here's United Continental. We talked about this as one of my favorite airlines. Here's a cheap silver play, cheap, cheap, cheap. And I probably wouldn't touch it till it gets above 5, but it made my radar screen. It looks like it too is done falling, but it's got to show it's time to go up. Talked about Bit Auto setting up here. Here's Beta. Here's another gold, Rand Gold, above the 50. Had a PSA reversal, a mobile breakout, and a squeeze on Friday. Makes money. Infinity Pharmaceuticals, they've got a partnership with ABBV that looks attractive. Another potential takeout candidate in biopharma. Number of products in late stage. It had that pattern like Intercept where it ran up big and then came back down to ground. This is a weekly chart. I think this is a low risk place to be buying it, but you can only buy so many. It's not a speculative potential takeout. Radon Group ran up, pulled back to the 50. Looks like it's taken off. Had a PSA reversal, mobile breakout from a squeeze this week. Southwest Airlines, what can you say? Tight, lower left, upper right, leader, done. Lynn Energy is that energy play we mentioned earlier. Burlington Stores is a retail outlet retail play that I like. Pull back a little bit down to the 17. Had a pocket pivot on Friday. Might be nibbling there. Then we have a series of tankers. Don't know what to do with this. I guess low cost of oil will utilize more oil. Therefore, there'll be more shipping of oil. I guess, because I don't care which tanker I look at. This is TK, pays a 2.3% dividend. We'll look at a couple more. This is Tesoro, a refiner. Pull back towards the 50, breaking out. This has been a nice leader. This is an Indian bank, IBN. And I read some articles where this might be a big winner with low oil costs and the expansion of the middle class of India. This obviously is risky when I say it's an Indian bank. Based, broke out on Friday with a pocket pivot kahuna and a mobile breakout. Veristem is a cheap biotech stock, kind of a speculative play. Here is another tanker, NAT, that has a 5.5% dividend. Here's why I talked about it, like Beta and like VIPs, setting up from a base. Don't like this one nearly as much. It's way below the 50. I should take it off my list. Here's another REIT, AVIV. Also, this is a nursing home owner. Nice lower left, upper right. Pays a 4% dividend. SIMO is our technology play, sort of in a gradual pullback to the 50 where it bounced on Friday with a mobile breakup from a squeeze. Pocket pivot and a forced kahuna. Cheap gold stock above the 50, which is NGD, New Gold. And then an inexpensive new play in steel, TMST, broke above the 50, speculative, it's a new issue. Blackstone Mortgage Trust, I think this was a spin-off from Blackstone. And you could see, sort of doesn't look like much, kind of sideways here, but it pays a 7.1% dividend. Frankly, with my thoughts about the market, if you told me I could keep my price the same and get a 7% dividend over the next 6 months, I might not be too disappointed. Here is a oil partnership that behaves like a REIT. This is Memorial Production Partners. They pay a 14% dividend if they can bring that in. They have a cash flow of over $3. Can you pay out $2? I don't know. But it too looks like it bottomed. And even if the yield gets cut in half, that's a pretty impressive yield. Phillips 66 Partners, 1.8%. This is another MLP pipeline. Here's that BCLI that popped to 7.5. Here's NMM, another shipper, marine shipper, and paid a dividend of 16.1%, NMM. And then lastly, I put this here mostly to watch. You had a couple of kahunas come in last week on Fairway. Fairway is a great food store if you live in New York. They went public this year, and you can see what's happened since they went public, actually in June of 13. Dropped from about 28 to where it sits at 3. Is this company going out of business? It doesn't look like it from a shopper perspective. It makes no money, which is bothersome. 70% institutional held. I kind of look this as an intriguing buy some and forget about it, high risk play. This is not a high growth stock play. This is more a play on the fact that the group is strong. It had a couple of kahunas, and I really like shopping there. My favorite part is that rather than have a regular freezer, they have a freezer area where you put on a jacket and walk through everything sitting out on shelves, but the room is kept very cold. It's a great store, horrible stock. Don't buy this because it's a growth stock. I mean, I'm going to watch it, see if those kahunas lead to anything. On that note, let me just conclude by going back up to 2 invites. Again, webinar this Wednesday, January 7th, 8 p.m. with George Lee and I. And for those that are on the fence, now's the time to get off the fence. And please email me that you're coming and send me a check so I can hold your spot. I'm probably going to take 5 more people. Saying that you're coming without a check does not count unless your initials are JA. And other than that, I look forward to seeing you soon. Good night, everybody. Good day, everybody. Enjoy some football. Spend time with your family, and let's see what this week brings. Goodbye.